Hey everybody, Amin Reina here from Sage Investors. Want to talk a little bit today about a recent post that I have done on my website, sageinvestors.ca. It's a recurring post. One of the things I like to do once a year is I post a scorecard where I list out and do a bit of a deep dive into my most recent 100 investment decisions. And the whole point of it is part of my what I do. And the reason what I do is teach people how to make better investment decisions. And I really believe it's one thing to teach this stuff, to teach the materials, teach the mechanical side, the behavioral side of making investment decisions. It's another thing to actually model the behavior. It's another thing to walk the talk. And what I do a couple of times a year, at the end of the year, I do a year-end review of how things have gone with me personally with my investment decisions. But in the midway point of the year, I like to post basically this last 100 scorecard. I've been doing this for a long time now, and I think this is the ninth edition of the scorecard. And to me, it's a really deep dive exercise into how I'm doing. Like, am I doing this investing thing right? Identify what's good about the decisions I'm making, what's bad about the decisions I'm making, what issues am I running into, and just learn. It's my own personal learning exercise. And as an investment, I said it's fundamental for me to be that have that transparency to my students, to my clients, to show, hey, like to demonstrate that, the stuff that I'm teaching you guys is this stuff really it's sticky. So if you go on my website, I've posted my most recent scorecard going up to July 2025, and check it out. It's on the website. And but what I wanted to do is do something next level with it instead of me just sitting here and just going through the results and everything. I thought, hey, let's what would happen if I got AI involved into this? So I took my analysis, I took the data from the from what came out of the scorecard this year, and I fed it into I let AI have a go at it and asked it to tell me about it. Tell me how I did. Tell me what's good. Tell me what's not good. Give me some insights into my scorecard for this year. And so I did. So what you're going to listen to now is AI critiquing my last 100 investment decisions and pretty much laying it out. The cool thing I'm using, just for disclosure, I am using the Google Notebook um, app. And the cool thing about the Google Notebook app is that it has a feature where it can actually convert your whatever you have, whatever data and everything into a discussion audio format. So, and now it's actually interesting. This is what I'm interested to try in this particular iteration is it's not just talking in the sense there's actually you can put it in a debate format. So in this, what you're going to listen to here is essentially a debate by two AI people, and actually I feel like there's like maybe more. You tell me, because there's like some other voices that kind of come in halfway through it, and I'm like, where did they come from? So I don't know, maybe it's AI doing AI, but I really want to get into the content because it was really interesting. And listen to it. I'll play it out here for you right now. And after that, we'll jump back on here. Me, we'll jump back on here and we'll have some we'll have some words about it. All right, so listen in and hope you enjoy it. And again, if you want to reference the actual scorecard, it's on my website, sageinvestors.ca. Just go look under the blog page. All right, enjoy.
Welcome to The Debate. Our focus today is a really insightful document, My Last 100 Trades, a 2025 performance scorecard. Now, this material gives us a pretty rigorous, data-driven look at how an investment coach is managing real-world portfolios using a formalized, rules-based system, what they call a playbook. But, the data seems to reveal a fundamental tension right at the heart of modern markets.
hmm And the central question we really need to tackle is whether this strict, rules-based approach. I'm talking specifically about the non-negotiable 20% stop loss and the 20% profit target, whether that adequately protects the investor from the behavioral risks that are just endemic to this contemporary zero-friction trading environment. Where impulse is literally just a click away.
Exactly. And I'll be arguing that these explicit quantitative rules, they successfully act as the necessary psychological and financial firewall. Basically, they impose discipline regardless of market volatility or how fast transactions happen, and this leads to, well, measurable success.
Okay, I come at it from a slightly different way. While I agree the playbook is a critical tool, especially for damage control, I'm going to contend that the behavioral drift, the one driven by just how easy modern execution is still deeply eroding the long-term discipline that the author themselves preaches. And we see this not so much in the return numbers, but in the sustained reduction of average holding periods. It suggests the trading environment is kind of winning the psychological war.
All right. Well, let's lay out the case for the playbook then. The data, I think, clearly demonstrates its efficacy as an essential emotional guardrail. It successfully manages risk while optimizing gains, and it achieves exactly what it set out to do. Essentially, take the emotion out of the decision-making process. And the consistency is frankly quite remarkable, netting 67 profitable decisions out of the last 100. Now, this is a robust result, especially considering it spans multiple volatile market cycles. Everything from the COVID-19 recovery right up to the recent 2025 global trade tensions.
Hmm.
And crucially, the loss control mechanism, it's performing exactly as designed. That non-negotiable stop-loss rule means the average loss across those 33 losing positions was contained at 16.5%. Okay, yes, it's slightly up from last year, but it is well within the defined risk parameters, and maybe most importantly, it prevents the kind of catastrophic behavioral mistakes that can just wipe out portfolios. Then, on the upside, 37 of those 100 decisions actually hit the 20% profit target. Now, this isn't just luck. This is discipline capturing, accessible upside and systematically defining what enough is before greed can really take hold. The system seems fundamentally resilient.
That statistical breakdown is compelling, I'll give you that. And I absolutely concede the playbook excels at damage control. I mean, an average return of 8.28% over that period is indeed impressive, proving the system is profitable. However, I think focusing solely on those return figures ignores let's call it the behavioral casualty, the erosion of patience.
Hmm.
My core claim is that this zero-friction environment is really driving the investor towards shorter-term, more tactical trading, which fundamentally contradicts the author's own stated philosophy of investing in, well-run companies for the long term. And the evidence for this is that undeniable downward trend in holding periods. The average holding period dropped to 321 days this year. That's a really significant slide from the 413 days recorded when tracking first began, 9 years ago?
Okay.
And the author himself has explicitly cautioned that these zero commission trades, they reduce mental friction and they risk turning sober investing into portfolio entertainment or simply just gambling. You can see the effect pretty clearly in the compressed timeline of the scorecard itself. These same 100 decisions used to cover a span of about 12.5 years back in the 2017 review. This year, those same 100 decisions were achieved in approximately 4 years and 6 months. That enormous acceleration implies drastically higher turnover and, frankly, a much shorter commitment to fundamental value. It feels like it's turning long-term investing into a kind of financial high-speed chess.
Okay, I see why you think the pace is problematic, but let me offer maybe a different perspective here, focusing specifically on the intentional design of those exit strategies. These 20% guardrails, they are the necessary, systematic counterbalance to the market's velocity.
How so?
Well, by systematically cutting losses at an average of 16.5%, the playbook protects the investor not just mathematically, but psychologically too. We know the math, right? The brutally unforgiving mathematics of loss recovery means a 50% loss needs a 100% gain just to break even. That kind of setback often induces psychological paralysis, or worse, desperate, irrational trading. So, by adhering to the stop-loss rule consistently, the investor preserves capital and, critically, maintains the mental fortitude needed to stay engaged and execute the next potentially profitable trade. The system's consistency, year after year, I think validates that this intentional friction is holding up against the market speed.
That's a compelling argument for the psychological value of loss control, yeah. But have you considered maybe the conceptual cost of the profit capping? If your initial fundamental research confirms a company is well run with strong economic profit, why are you consistently choosing to just bank the profit at a mechanical 20% threshold?
Because it enforces discipline against greed.
But look at the data, it shows a distinct clustering. 40.3% of the profitable trades yielded somewhere between 20% and just under 30%. This suggests the investors prioritizing the rule over, perhaps, the potential justified upside of the underlying asset. They seem to be choosing mechanical certainty over fundamental conviction. And this, I think, leads to the critical vulnerability shown by the difference between the median and average returns. The median return is 16.8%, which, okay, that's excellent. But the average return is only 8.28%. Why the massive gap? It's because the few large losses, like that Novo Nordisk example at negative 33.9%, disproportionately hurt the portfolio average.
I'm sorry, but I just don't quite buy that interpretation. Let me tell you why. That gap, for me, proves that while the playbook generates a reliable stream of these median wins, the system is indeed highly vulnerable to catastrophic outliers if they manage to slip past the loss control mechanism, or perhaps, as you hinted, where the rule wasn't strictly followed initially.
Exactly. So the fragility suggests that relying on rules alone isn't enough when the underlying behavioral pressure leads to these missteps that have outsized negative consequences.
But I would argue that the case you highlight, those few instances of deeper loss, actually proves the necessity of the rule, not its failure. When the investor, for whatever reason, didn't follow the rule strictly, they suffered disproportionately. When they did follow it, 33 losses were contained right around that 16.5% mark. The rule acts like the safety net that successfully catches most falls, preserving the overall capital base. Without it, that 8.28% average return would likely collapse.
Okay. Let's maybe shift back then to the meaning of these decreasing holding periods. The average holding period is now just under a year, 321 days. This feels like a substantial move away from that guiding principle of prioritizing time in the market over timing the market. If the goal is genuinely long-term wealth building, doesn't this higher transaction velocity suggest the environment is successfully converting the patient investor into more of a tactical trader?
Or maybe just a more efficient one.
Well, consider this. If the author is focused on economic profit and strong management, why are they repeating 87 transactions? I mean, buying back into companies they just sold. This re-entry suggests, to me at least, unnecessary complexity and, yes, potentially transaction costs, perhaps driven by the psychological ease of execution that the zero-friction environment provides. It feels like it encourages constant tinkering rather than letting the fundamental thesis truly play out over time.
I'm still not convinced by that line of reasoning, because for me, the decrease in holding period is simply an optimization. It's an adaptation to what is genuinely a more dynamic market, not necessarily a sign of failed discipline. The market is moving faster, and the discipline system is simply capturing returns faster.
So speed itself isn't the issue?
Not if the discipline holds. The author maintained core principles, investing in fundamentally strong companies, but achieved the system's predefined exit targets sooner. Look, if a fundamental thesis plays out and generates a 20% return in, say, 6 months instead of 2 years, the disciplined move is to capture that gain and redeploy the capital. The average return of 8.28% is, as the author notes, well above the long-term returns of stocks and well above the rate of inflation. This validates that the discipline system works regardless of whether the hold is 413 days or 321 days. The holding period reduction is, arguably, a neutral outcome because the exit rules are consistently applied, controlling the behavior at those critical moments of entry and exit.
Think about it. If the rules were truly failing behaviorally, wouldn't we see catastrophic, uncontrolled losses popping up more frequently,
rather than losses largely contained around that 16.5% average. The fact that the average loss aligns so closely with the 20% rule suggests the discipline is being imposed, even if the holding period itself shrinks.
That's a fair counter, I admit. But the shortening time frame still forces a change in behavior, specifically, I think, regarding risk concentration. Let's look at the sector performance you mentioned earlier. You correctly noted the success. Financials, for example, highly successful, generating a 23.4% average return. Technology also performed well. And this consistency does show that the underlying stock selection is robust. I grant you that.
Right.
However, the question is what psychological cost this success might be extracting. The author themselves admitted this year showed a higher concentration of decisions made with consumer discretionary and financial stocks, which is a deviation from previous, maybe more broad-based exposure. I'd argue that the pressure to execute the playbook quickly in this zero-friction environment tends to favor chasing sectors that are moving right now, leading inevitably to this narrower focus. The pursuit of rapid, repeatable 20% gains almost naturally encourages concentration in whatever sectors have momentum.
But momentum driven by fundamentals.
Perhaps, but while the results are strong now, this concentration, combined with acknowledged geopolitical risks like the 2025 U.S. global trade war, will absolutely test the ideology's narrative. I mean, the author concludes by saying that ensuring diversification geographically and across various asset classes will be critical to how I frame investment decisions going forward. This admission seems to imply that the rules-based playbook, successful as it is right now, might be insufficient on its own to handle future systemic risk, precisely because the current execution style has pushed them into a concentration that they now recognize they must actively correct.
I see that differently. The strength of those sector results, particularly in financials and technology, demonstrates that the fundamental selection process remains robust. The playbook isn't forcing concentration, it's simply allowing the investor to monetize where the market opportunities exist fastest. When the fundamental stock selection works, the rules ensure that those profits are banked systematically. And the fact that the author is actively considering future diversification just shows prudent, rules-based risk management extending beyond individual trades. It shows the learning system is adaptive and self-correcting. The playbook is a framework for behavior, not some static ideology set in stone.
Okay.
So, look, I think we can both agree the playbook provides an exceptional quantitative measure of discipline that achieves tangible success, a 67% success rate, a 16.8% median return. It fulfills that primary function of capital preservation by systematically limiting mistakes, keeping those average losses at a very manageable 16.5%. The rules are fundamentally the intentional friction that's necessary to combat impulse in today's market.
Yes, I agree that the rules are an essential risk management tool. Absolutely. However, that undeniable year-over-year trend toward shorter holding periods, which the author themselves acknowledges, suggests to me that the corrosive influence of the modern, frictionless environment remains a critical behavioral risk. It subtly forces even the disciplined investor toward a higher velocity of decisions and potentially greater transactional risk and maybe even concentration risk, even if the rules manage to keep their performance numbers looking good. Well, for the time being at least.
And I suppose the value of this rigorous review, this scorecard, is that it provides that quantitative foundation for discipline, allowing for exactly this kind of analysis and adjustment.
Indeed. And the scorecard highlights exactly why the self-analysis really never stops for investors who are trying to navigate market cycles that just seem to be getting increasingly complex and, frankly, moving ever faster.
Okay, there you go. There we have it. Interesting. So just for disclosure, we're back to me. Like we're not doing the AI thing anymore. It's me. It's 100% me again. So tangible everything. So there you have it. There's a conversation, an AI infused conversation regarding my last 100 investment decisions. Now, I'm probably going to do a deeper dive on the whole AI thing right now because I do have thoughts. I have updated thoughts about AI. So I'm going to park those for another episode. I did an episode way back about a year, over a year ago, the early days of when ChatGPT came up, and I had some takes on it from an investment perspective, and a lot of things have definitely changed since then. So we'll park the technical side of it there. The only one observation that I would make right now with the AI stuff as it pertains to what we're talking about here is just everybody, the value proposition talks about productivity. Well, just for disclosure, I'm probably spending more time doing this particular type of episode, podcast, and video than I would if I didn't have AI. So take it for what it was. But on the flip side, as we're going to talk about, we got some interesting insights. So just again, the disclosure, I use the notebook, the Google Notebook AI tool where you just put in your content or documents or whatever, and it'll spew out all kinds of different formats of that of your document of your content. And one of the ways you can do it is it can actually generate conversation of an audio document of whatever you've written. And what's interesting, what this time I you have options, and this is talks about the evolution of how AI is evolving. You have options. You can have just a standard kind of summary kind of audio conversation, or you can now have what's called debate mode, where you can have two people actually taking sides on whatever it is you've posted and presenting their arguments to it. So I said, let's do the debate side of it. So what you heard here is a conversation or a debate between two people uh, about my analysis, about what I discovered through my last 100 investment decisions. And I'll be honest, uh, I didn't think there would be it'd be I thought it would be pretty regurgitated or like, repetitive kind of thing, but it was actually interesting, and it actually highlighted some things that perspectives that I don't know if I really hit on them as much in my write-up. So let's go through it, and because I think this is good, could be decent stuff for people. So as I said, there's two people on this argument having this argument, debate on it. I'm going to go through what each of the debaters presented and share their insights on there. So I'm going to talk about first of all the second person that you heard, the person that I think was a little bit more critical and a little bit more skeptical about the outcomes that I had presented. I think they were impressed by it, but they had some reservations about, how I got to the results that I got. So let's talk about what their perspective is. The first person seemed to be pretty much like, yeah, yes, like this is awesome kind of thing. So we'll save that one, but let's just talk about from a more critical side because I think that's where the interesting discussion comes out of it. So the second person argues that, the results are good. It doesn't deny or dispute the results that, that I've posted. What it argues is certain qualitative elements that are probably holding me back. And the one first thing it talks about is the sort of the thresholds that I have, this 20% that I have in my playbook, this 20% return that I try to seek with every investment decision that I make. And if I cross that return, I pretty much sell it. Um, and it's questioning whether that's a really good strategy in the sense that you potentially could be leaving money on the table, which is true. For example, if I think my analysis is saying, this stock is worth, potentially I can make a 40% or 50% return on it, it questions the AI is questioning why are you selling it? Why are you going through the exercise of analyzing stuff if you're just gonna take the profit earlier? It cites the data talking about how a lot of my positive investment decisions were clustered around the 20% to 30% range. And so it had some, saying, why are you leaving money on the table? That's one element. The second element is talking about the repeat decisions. And a lot of times my investment decisions revolve around, if I bank 20%, 25%, I'll sell it. But if the stock goes back down and then goes back to a lower price point, I'll come back in. And I do that quite a bit. I do cycle. To me, it's a much more tolerable for my personal risk tolerance to do it that way. And because at that point, I think there's better investment opportunities elsewhere where I can get that quick 20% possibility there. Um, so the AI questions why the whole why are you bothering just to you're going to end up buying the stock anyway, so back again anyway, so why sell it? Why don't you just hold it and retain the value over time? Um, and yeah, it's absolutely legitimate. I don't dispute that at all. What's comfortable for me, and again, this is what's at the end of the day, what's comfortable for us personally when we're making investment decisions is about risk. What can you tolerate? And the 20% threshold that I personally set in my playbook when I make decisions is my comfort level. It's my enough. I am satisfied that I am meeting all my return expectations, i.e., earning at least the rate of inflation, earning at least the long-term rate of return, and then having a premium on top of it. It's enough for me. I'm happy to cycle through that. Am I leaving money on the table? Yeah, of course. But I'm also opening myself up to losing money too. So 20% profit that you have or 30% profit you have on a stock is 30% once you sell it, it's banked and it's in your bank account. So I'm okay with that. Other people might not be, but this is again, this is my game that I'm playing. This I'm sharing my game, and I don't expect everybody in the planet to play my game. I expect everybody on the planet to play their game. So what does it say? It says I'm basically saying I'm in short, no other words, that I'm prioritizing my playbook and my rules that I've established in my playbook, my criteria at a much higher expense. I'm costing myself additional profit. And my response is that thresholds that I have set are enough for me. I'm enough. I sleep well. I'm content. It pushes the greed element, the emotional side of the decision making, it pushes it away. And I can live well. I can live with it. It cites to further reinforce the point, the AI then cites that variance that I have between the median return and the average return. As remember, my median return was about 16%, my average return was about 8.5. And it's basically citing that the reason why there's that high variance could be potentially because the stocks that I did end up selling, the few number, the 33 out of this 100 did a little bit more damage to that overall return threshold than it should have. And again, the response that I have is a lot about, I don't want to lose is controlling losses. We've spent so much time trying to figure out what stocks we want to buy, what ETFs we want to buy, and to make as much money as we can. We don't forget the concept that, you know what, we will make mistakes. We are going to make mistakes. I make mistakes all the time. And you have to learn how to manage the losses. Because if you don't, that's the one thing that really kills people with investing is they let their emotions run amok and their profits and the overall pie that they're trying to save up for start shrinking, and it's hard to get back. So I prefer to sleep at night and knowing that I have control over the bad decisions that I make. The other thing, the AI, the contrary AI or AI 2, thing one, thing two, AI 1, AI 2 here is talking about is what's driving, the results that I'm getting is the environment. And I've talked about it also a little bit, alluded to it, is that we're in an environment now. The AI 2 seem to be very focused on my holding periods. And as the article shows that over the last 9 years, which I've been doing this, my holding periods have fallen quite a bit. And I personally think it does have a lot to do with the frictionless trading environment that we are living in now, the tools that technology has provided us to make decisions literally on a whim without, zero costs. It's just easy to invest now. And ultimately, it's saying because of that frictionless, easy ability to do it, I'm making decisions faster, and that potentially is holding me back. And that I should be really, truly, if I believe in long-term investing, I should be holding my stocks for a lot longer period of time. And I do agree with that. And I do try to make an effort to try to hold stocks longer. I try to make an effort to spread out when I buy stocks, try to spread them out, try to be more concentrated when I buy them, to control my costs. And I think over the last few years, I think when COVID happened, I think things went a little bit cuckoo there, but I think I've got things a little bit better under control. And but yeah, it's the ability to pick up a phone and just make your trades and make your decisions right there on a whim based on what somebody might say on TikTok or somebody might say on CNBC. It's really easy to do. It's a game now. And yeah, I think that does play into a factor. I think there is that psychological and that behavioral element that technology is enabling, that really challenges our long-term type investing ideology. Um, and the AI too is basically arguing that the technology is winning out, and it's putting pressure on us to make longer term commitments on our investment decisions and potentially is leaving money on the table. So this is what AI 2 is kind of like hitting on, and I think they're pretty valid points. I don't really disagree with what they're saying. And I think as best as investors we can be aware of these. And so when we're framing these decisions going forward, that, we have that element behind us. So that's another, so it was kind of, I wouldn't say hung up, but really focusing their argument on these elements. The other element that they noticed too, that they were a little bit critical of, was that my decisions were very highly concentrated in that looking back at the last 100, a greater proportion of those investment decisions were centered around discretionary, consumer discretionary and financial stocks. And AI2 basically is saying the pressure to execute in a zero friction environment is helping me or pushing me to chase chase the winners, chase the hot sectors, um, which thinks that is giving me a much more narrower focus. I'm not focusing on a broader way. And so this one I kind of will push back in that, yeah, well, the data has shown that I do have favored consumer discretionary and financial stocks. Regular people you'll know who follow me and listen to stuff that I do and have worked with me will know that up until maybe 3 years ago, I had never owned a bank stock. I had never owned a financial stock or a financial company. But it came to a point with interest rates starting to go up that I thought bank stocks were actually now cheap. And actually, there was a potential investment. And so I did buy JP Morgan. I did buy TD. I did buy RBC. These are stocks I would have never bought. In my entire 20 plus 5 plus years of investing, I've never owned bank stocks or financials. So yeah, it is kind of weird. And I've said investing has been very weird for me because I'm owning things that I buy bonds. Like now I have material exposure to fixed income. I never had that. So I'm kind of dispute their claim that, yeah, the numbers show I do have concentration, but it's not something it's always been there. It's a new thing for me, and I'm still kind of personally trying to digest it. So the AI2 is basically arguing because you're focusing on too many specific sections that it's facilitating repeat trades. That's whole repeat trades, while I'm kind of cycling through companies, is that it's just adding to your uh, bias, I guess, to focus on specific sectors. And I would say yes, but not for those particular reasons. I think I agree that, yeah, it does focus me to concentrate, but I think what it's done is this repeat trading element has focused me to focus on areas that, in a way, this is kind of like recency bias, uh, that could be playing into it. The fact that, hey, I made money in this stock before, the stock is down, I should get back into it because it worked last time, so it's going to work this time. And so I think I am directly playing into some recency bias when I'm making those type of recycling, kind of cycling through kind of decisions. Uh, I think that's a play there. I think that is definitely there. But I'm not doing it, oh, it's down, I'll go buy it. One of the fundamental things is if it is a stock does that I've owned in the past, I sell it and it goes back down, I'll go back into it if the fundamentals are great. If the fundamentals of the company that made me buy it the first time are still in play, it's just the market is just mispricing it or discounting it more because of broader, macro issues, then yeah, I'll probably go back into it. But I don't think it's sort of like a algorithmic, well, stock's down, automatically go buy it. I think the part of the discipline that I built in my playbook and how I frame my decisions is all about making sure quality, well-run businesses selling at a discount. Those elements are there. Uh, So these are good points. Like I don't really disagree, and I honestly was not expecting this. I was expecting more of a regurgitation of what I wrote, but it's kind of taken what I wrote and then kind of been a little bit more critical than maybe I would have than I was thinking. So these are good things. These are positive things that have come out of this discussion. Came out of this evaluation, this AI debate kind of thing. The other element that AI2 was arguing too was that I talked about, and people who follow me now know my mindset in terms of how I make decisions now is very different in the sense that of what's going on now, what's going on in the business world, what's going on in the economic world, what's going on in the political world. We got a Mad King on the run, doing a whole bunch of things that are destroying value propositions, traditional value propositions, traditional investing value propositions. And it argues that AI2 is basically saying that the playbook that I'm using right now in this world may not be very relevant or may not be working as effectively. And I've said, yeah, I agree. And now my playbook is not necessarily about looking for individual companies because of that oversight, government oversight mentality that is taking hold. And it's more about just owning a basket of equities, owning a basket of bonds, owning a basket of commodities, income generating commodities or things like that, and holding a geographic basket because I cannot figure out what's going to come next. Things are so uncertain right now. I just can't put my money into a specific company and the next day I pick it up and the Mad King is trash talking it down. It just it can't live. We can't make investment decisions like this. And I'm one investor. Imagine running a company right now. So I have admitted to this that my playbook is going to be a little bit compromised in the sense, and that I have to evolve with it. I have to evolve with the environment here, and having an open mind. Um, and I do admit it that that my decisions might that I make under my traditional type playbook may not be sufficient enough to handle these craziness that's going on, and and I think it's pushed me to react to the way I've reacted. So interesting point. So that's a lot there. It was a 14-minute discussion, and these are all the elements that came up with it. Self-analysis, at the end of the day, the comment that came out of it from AI2 is self-analysis really never stops, especially in markets getting more shorter and complex. And that is a very profound kind of observation that and I'll save it to the end, but that's how AI2 kind of wrapped up their arguments for it. So that's AI2, pretty critical on that side. AI1, let's so the AI1 who initiated the debate. Let's talk about what their observations were and what they were arguing. They argued that what I was doing was great, basically. Like it was literally stroking the ego kind of thing. Um, and I think it looked at its criticism or critical analysis of what of my decision making focused a lot more on the quantitative aspects of it. Bottom line is you're generating good returns, your performance is solid, you've minimized losses, you're controlling your losses. The way you've set up having a playbook, you've instilled essentially a firewall and a discipline to how I make decisions. And it's basically said my approach to controlling losses is working. It's containing losses. I'm preventing catastrophic type losses, and that my approach is providing the necessary guardrails. It's doing what I'm hoping to do. So in a way, it's patting me on my head saying, good job. It's good in the sense it likes that it's the emotion component of making decisions is kind of parked. Um, it was incredibly impressed by the consistency level, the fact that, you know what, two-thirds of the decisions that I made were profitable decisions. Um, and it basically saying this is a credible analysis because it's spanning multiple period. It's not just a short timeline here. The timeline is almost 4 years, 5 years. So a lot of things have happened in the last 5 years. And so the ability to maintain that level of consistency was they highlighted it. It talks about protecting from making the psychological elements and the biases that taking this approach to taking the emotion is just preventing potential for excess loss and potentially preventing irrational decision making. And the other thing that it argued too is by having this approach is that it keeps you engaged. And again, that's one of my big themes of what I do as an investment coach is I try to keep people engaged in the process. Nothing keeps you more engaged than actually making successful investment decisions. If things are doing what they're supposed to be doing, you're going to be more engaged in it. If you're doing things and you keep losing and losing and losing, what's your motivation level to stay engaged in the process? What's going to happen is then you start doubling down, loss aversion, all these wonderful other emotional biases can start creeping in and start flipping the script and take you to an even darker spot. Um, it argued AI2's comment that I'm leaving money on the table um, by saying that the system or the approach that I'm taking, basically saying the markets are always open to long tail market events, sudden shocks to the system. And the approach that I'm taking to it, while, yeah, leaving money on the table, it is preventing my portfolios from getting exposed to a significant market event. And considering where I am in my life, the age of my life, my demographic that I'm in right now, those aren't bad things. So, and the other fact of the matter is, it argues is that markets just simply are moving faster. Markets react to things a lot faster. Cycles are shorter, which could explain why holding periods are shorter that I have. Um, but it argues, contrary to AI2, that faster markets shouldn't be an issue if you are disciplined enough to maintain your core principles, your core investing principles, your core investing ideology. Because as I argue, your investing ideology is stickier, it's more um, resistant, it's more resilient than picking up and seeing what's on TikTok. And the AI one also argues um, that if I didn't do any of this, that my returns would have been significantly lower if I didn't have this disciplined framework, playbook, decision-making process that I have. So it's all in on what I've done. It seems to be pretty happy with what I've done. AI one also talks when kind of counters AI two's points about my portfolios being too concentrated in specific sectors. AI1 argues that concentration really isn't a factor. The fact that I am concentrated in financials was because those opportunities were presented to myself. I recognized those opportunities and I took the profits on them and I capitalized them. I didn't just say, oh, okay. Now, I argue a lot of times that you're not going to get everything. You're not going to find everything, every trend and everything. You're not going to make every trend. That's just a reality. That's just investing. That's just the occupational hazard. So AI one is arguing that concentration, at the end of the day, if you're finding investing opportunities, you're finding stocks or ETF sectors that are undervalued, underappreciated, and are quality, and you feel have potential long-term investment potential to generate returns that you're seeking, you go there. The other thing it talked about is that, you know what? Having an ability to shift and to be more broadly diversified is it kind of said that's a good approach. It's showing that you are adaptable. And I think that I'm willing to adapt to the current geopolitical issues that are out there. Um, Adapting is a prudent thing to do. It's a prudent rules-based approach to risk management. That's what it said. And it basically evaluates that the system that I have, that my approach that I take is very adaptive, very malleable, and it's all a product of having that open mind to opportunities, investment opportunities. As I said, I never invested in bonds, I never invested in bank stocks, but here I am, and it's been pretty decent, as the data has shown. Um, Ultimately, I came up with a couple of holistic observations and saying having a playbook is basically a framework for behavior. It's not a framework for a specific ideology. It's not set in stone. Your ideology evolves over time and it stays very sticky. And these are concepts that I talk about quite a bit. These are the core elements so it's nice to see it actually reinforce those elements. Um, what else did it say? It said it's a successful quantitative measure of discipline that achieves tangible success. It fulfills, the approach that I've taken fulfills capital preservation. It limits mistakes, and when mistakes occur, they are managed appropriately. Um, and it argues that having the approach that I take and having this kind of approach of a rules-based approach and taking a playbook kind of mentality is a good counter to the frictionless world that is out there. Having a playbook is essentially friction. It is internal friction to counter, to respond to now what is evolving as a very frictionless investing environment. And um, I thought that was quite interesting. I thought that was quite nice. I was like, that makes sense. So there you go. So this is my last 100 investment decisions. You can go on my website. I'll put a link on the description. Have a read. But then, you know, especially if you're gonna go read it now, if you've listened to this episode and go and now read the document, I think maybe things might be a little bit more, even more, hopefully clear in that sense. Uh, but yeah, this is really interesting stuff. What has come out of this exercise. And again, I want to highlight the final thing that the episode talked about was that the whole, like, why am I doing this? Part of why I am doing this is obviously to be transparent to people about what I do, because if I'm teaching people how to make investment decisions, I should be transparent enough to show them how to having these principles in your pocket can get you to a good place. And sharing people my outcomes and decisions that I'm facing is part, hopefully, to add the value to it. So that's part I do it. A lot of it is self-analysis. I do that specifically the last 100 and my year-end review that I do at the end of each calendar year. It's self-analysis for me. Yeah, I teach people invest. I teach people how to make decisions. But does that mean I know everything and have all the answers? No. Part of investing is, as the AI is saying, is about self-analysis. You need to constantly keep reevaluating what you're doing. And the AI basically captures that and says self-analysis really never stops. And I think what it's even emphasizing more is that we have to be doing more self-analysis now, especially now in a time where the markets are evolving much faster and value propositions, traditional default investing decisions that we have made historically are pretty much under threat and are much more complex and much more nuanced. And so we need to constantly keep checking in with how we're making decisions, self-analyze. And to me, this exercise that I do with my last 100 investment decisions and my year-end review are those self-analysis exercises that I do. Do I expect everybody to go do this? No. But hopefully, if anything comes out of it, you'll see that value of self-analysis, of just stopping making decisions and just look at what decisions you're making. And are you on the right track? Are you still on your investing path? So, really interesting insights that came out of this whole exercise, just from one, me putting it together, and number two, having virtual AI people or things or whatever provide context, critical evaluation of it. There's a lot of learning here. I think I got a lot of learning out of this, and it's been a very interesting exercise. And so I hope this has been of value to you, and you can see the benefit of this having this framing in some points in your timeline for self-analysis on the decisions that you're making. And and at the end of the day, staying true to it. And at the end of the day, whatever analysis, whatever playbook you come up with, whatever your investing ideology, the takeaway is you keep doing it and you don't just give up on it because it just didn't work for a couple of weeks. And I think technology, the frictionless nature of technology makes it much easier to give up pretty fast and pivot. Pivot's good, but it's got to be in alignment with your core investing ideology. So that's all I got for you today. If you're interested in more information, obviously I'll put a link to the article, but if you want more insights into all about things about investing decisions, you can find me at sageinvestors.ca. As I said, I teach people how to make investment decisions. I've set up a really interesting learning platform called the Everyday Investing Collection, a series of online courses, and additional resources, online resources, references, resources, AI related components to help you make better investment decisions in whatever path you choose to take. So check it out. It's on the website, sageinvestors.ca. You can find me on Threads. You can find me on Blue Sky. You won't find me on that other bird website, not on there anymore. You can find me on LinkedIn. Just do searches for Sage Investors. The episodes here are also on YouTube and they are also on Apple Podcasts. So find me wherever you want. And if you have questions about my coaching programs and my courses and anything else investing related, you can hit me at any of those particular platforms. So thanks for listening in. Thanks for watching in. It's been another episode of Stock Talk. This has been the last 100 episode edition. And thanks for listening in. Again, Amin Reina here from Sage Investors. We'll catch you again another time. Take care. Bye bye.